Imagine waking up to headlines announcing that nearly 1 billion institutional dollars suddenly rushed into Bitcoin within 3 sunrise cycles, revealing an invisible tug-of-war between fear-selling and deep-pocket accumulation. At first glance, the chart looked overwhelmingly frightening because Bitcoin slipped below $105,000 after geopolitical panic. Yet hidden money flows quietly told a completely different, far more bullish story overall. That story begins with regulated exchange-traded funds, Wall Street vehicles letting pension managers click one button for blockchain exposure without juggling private keys, cold storage complications, or offshore exchanges. When those funds report truly historic inflows while retail sentiment stays fearful, seasoned investors understand the next momentum wave usually arrives weeks later, long after cautious mainstream headlines finally notice the silent buildup. Stick with me for 10 minutes and you will decode the mechanics behind that $970 million Wall Street reload, learn who bought, why they moved early, and craft your personal action plan. If you are new to crypto and still nursing portfolio bruises from last year's corrections, understanding institutional footprints transforms gut-driven trades into evidence-based decisions that preserve capital and maximize conviction. Experienced holders also benefit because deciphering flow data uncovers where smart money parks during volatility, revealing potential price floors and future narrative shifts before influencers start tweeting bullish emojis tomorrow. Here is the roadmap. First, we expose the inflow numbers and the funds responsible. Second, we link those flows to on-chain supply metrics. Third, we craft practical strategies for every risk profile. By the end, you will not simply know the headline. You will grasp deeper mechanics guiding institutional behavior, and that understanding creates clarity whenever the next scary candle flashes on your screen. Ready to turn fear into mastery and position yourself before the next surge appears to the wider public audience? Then keep listening carefully and take thoughtful notes because today's liquidity numbers are absolutely extraordinary. Over the last 72 hours, United States spot Bitcoin exchange-traded funds absorbed $970 million, erasing prior outflows and marking the strongest three-day streak since April. To put that in perspective, those funds captured roughly 9,200 Bitcoin at spot prices, enough to drain Coinbase's daily supply multiple times before miners could replenish inventory. The heavyweight leading this sudden charge was BlackRock's iShares Bitcoin Trust, ticker IBIT, which attracted roughly $430 million Tuesday after already securing $386 million the previous Monday. That massive burst swiftly lifted IBIT's assets beyond $70 billion, making it the fastest exchange-traded fund in financial history to cross that mark, outpacing several long-established equity and bond trackers worldwide. Yet IBIT was not alone. Fidelity's Wise Origin, ARK Invest's fund, and Bitwise's BITB all posted healthy inflows, confirming the move was broad-based rather than a single-issuer anomaly. Combined, the active spot funds now hold about $130 billion of Bitcoin, roughly 5% of circulating supply, and that share keeps climbing whenever miners cannot match demand. These inflows arrived while Middle East conflict headlines spooked traders, proving institutions treat Bitcoin less like a fragile tech stock and more like a long-term macro hedge comparable to scarce commodities. Independent analysts quickly highlighted that the intense four-day surge flipped June flows back to positive territory, clearly signaling renewed institutional appetite after earlier profit-taking briefly shook confidence across social feeds. Why do these numbers matter for you, an everyday investor building wealth one step at a time through disciplined accumulation while juggling family commitments and market anxiety each month, hoping for clarity? Exchange-traded fund demand absorbs free-floating supply permanently. Every significant net inflow mathematically tightens verifiable scarcity, making subsequent sharp corrections shallower, while future rallies often become steeper over the medium term. Picture a giant industrial vacuum on Wall Street desks, quietly sucking thousands of coins from circulation, while retail traders energetically debate chart patterns, indicators, and emotions on social media platforms around the globe during breakfast. Now overlay that invisible vacuum with on-chain data, revealing exchange reserves dropping 21% since early 2024, and a powerful squeeze narrative suddenly emerges beneath otherwise noisy and distracting price action. OTC desks reinforce the same picture, their balances falling a steep 36% in the identical window, suggesting whales transfer coins into deep cold storage warehouses instead of flipping for short-term speculative profits quickly. In simple terms, Wall Street is building a one-way valve where coins enter custodial vaults and seldom exit, forcing every new buyer to compete for a thinner slice of circulating supply. Why did that valve open precisely this week, when global risk sentiment looked shaky after missile strike headlines? Professional money loves forced selling events because they create temporary discounts. With Bitcoin dipping toward $103,000, funds seize the chance to average in at perceived value zones. Despite the intraday plunge, Bitcoin finished the week 1% higher than 7 days earlier, indicating underlying demand immediately soaked up panic supply. Whenever price stays flat yet, ETF flows soar, sellers essentially hand coins to institutions, transferring future upside from emotional traders to disciplined capital. That pattern echoes accumulation windows in 2020 and late 2022, both preceding multi-month rallies that surprised those who sold too soon. So how can you convert this institutional clue into an actionable plan without dabbling in complex derivatives or sleepless leverage? Step 1 is education. Track ETF dashboards on So-So Value or CoinGlass, setting an alert whenever net flows exceed $100 million in a session. Step 2 is allocation discipline. Commit a fixed percentage whenever 3 consecutive positive flow days appear, letting data rather than emotion guide entries. Step 3 is security fortification. As inflows accelerate, expect exchange withdrawals to intensify, so prepare a hardware wallet early to avoid congestion and premium fees at the peak of FOMO. Remember, nothing here is financial advice. This framework rests on publicly available numbers you can verify through official ETF filings and transparent dashboards. Some viewers worry ETFs undermine Bitcoin's ethos because custodians control keys, yet the coins remain on-chain and auditable, meaning transparency and fixed supply stay intact. Critics ask whether inflows can suddenly reverse. History says redemptions lag price by weeks, giving attentive investors time to react before heavy outflows surface. Monitoring flows is therefore a habit you schedule like gym sessions or weekly meal prep, not a one-off headline glance. Quick demonstration: open So-So Value, switch to month to date, and notice June flipping from negative 200 million to plus 970 million in 3 sessions. Combine that visual with coin market cap research traffic still dominated by Bitcoin, and you gain both capital commitment and attention momentum. Ethereum ETFs also logged 18 consecutive inflow days, yet totals remain smaller, showing macro investors still treat Bitcoin as the first liquidity gateway before rotating into higher beta assets. That rotation often triggers the so-called alt season, where capital trickles toward layer 2s, restaking protocols, and emerging meme ecosystems flagged in earlier episodes. Studying Bitcoin flows therefore reads like the front page of the entire crypto liquidity diary. Revisiting IBIT's milestone matters because milestones create FOMO. Surpassing 70 billion in assets within 11 months outpaced Vanguard's prior record and signaled institutional gatekeepers trust the instrument. Pension boards usually wait for such thresholds before filing investment proposals, meaning a second, potentially larger wave could appear when committees reconvene after fiscal year closes. If that unfolds, another news cycle similar to January's post-approval rally could push spot price toward new highs as fresh flows chase limited supply. Turning to supply, recent analysis shows exchange reserves now sitting near 2.5 million coins, the lowest since 2018. That stash equals less than 3% of total supply. So any demand shock from pension allocations becomes an asymmetric catalyst under the post-halving issuance schedule. You now possess the full puzzle. Heavy ETF accumulation, shrinking liquid supply, and macro catalysts that could lift Bitcoin once geopolitical nerves settle. Before we close, ask yourself this grounding question. Will you allow fear candles to transfer your position to Wall Street? Or will you harness institutional data to ride the same escalator upward? If you choose the latter, my free Bitcoin Mastery training teaches dashboard setup, disciplined entries, and military-grade cold storage techniques in 90 minutes. Start your crypto journey today. Click below for free beginner-friendly investment training and learn how to trade like a pro. Imagine opening Twitter during the next panic and feeling calm, because you know exactly where real money is moving and your action plan is already written. That confidence transforms you from reactive trader into strategic allocator, a shift that compounds wealth over years rather than hours. Smash the like button. If this breakdown clarified institutional flows, Subscribe for weekly data-driven insights, and remember to claim your spot in the free training linked below. Thank you for watching, stay curious, stay disciplined, and I will see you in the next episode. Until then, may your coins remain secure and your decisions powered by evidence, not emotion.